Welcome back to the Capital Mindset Show, guys. We're your hosts, Austin and Fabio, and today we have a special episode on Zillow and some of the things that are happening with Zillow right now. We thought it would be very interesting to kind of really talk about this company today and just kind of talk about the recent developments that have been taking place. This is not a preliminary analysis nor a deep dive, although we will put out a deep dive later about Zillow, but just sort of going into this, we're going to be kind of covering today what's going on with Zillow in terms of the business itself. We're also going to be covering as well, sort of a little bit of their capital structure, kind of going into that a little bit. And then also too, a couple of recent news events that have really happened with Zillow. So without further ado, Fabio, what are we looking at here today?
We're looking at what some are calling somewhat the Facebook or Google of home buying, because why some people say that is, I kind of agree to some extent, because when I go, oh, what's that home's value worth, or what's the home value in this area, I go on Zillow, for example, like that. I Google the property basically.
Yeah, same.
And I like some of the features that Zillow has. It makes it really easy for me to use, and that kind of is reflected in their numbers. Like their visitors are about 200 million per month, I think the company said. Mm-hmm. And that in of itself is like a very strong moat. But okay, so that all being said, we actually want to talk about the recent move first. So if I'm going to pull up their stock chart right now and give everyone kind of a taste as to what it is we're talking about. So let me actually make us a little bit bigger. We're not super small. And right here, we can kind of see, well, we have a 22% drop today. And I'm looking specifically at Zillow Group Class A. We'll talk about a little bit more later. So we can see here recently that we had this very big drop from about 105 and suddenly, down 37%. So this is a huge drawdown. And we can see that they've had a really good year. So if you were buying around here, you're still up significantly. You're up about 100%. You're buying in the 30s. But from the peaks, if you were buying there, unfortunately, you're down about 67%. All right. So what happened, right? We want to know that basically, not to bury the lead, they are exiting the iBuying business. Okay. So for those who do not know what the iBuying business is, the iBuying business is essentially these companies like Opendoor and Zillow offering purchase prices on real estate with the intention to flip it. And I think Redfin engaged in iBuying as well. I'm very certain on that. Not aside from Redfin's ancillary services, but these companies all decided to enter the iBuying. And I know I'm missing one company, right? Off the top of my head, I know it's Opendoor, Zillow. There's like one more. Someone in the comments section might be saying, you forgot about, yeah, I know, I forgot about that company. But sorry about that. So what the iBuying industry basically is intended to do, or theoretically supposed to be doing, is allowing these companies with greater amounts of data, with higher quality data, to buy and sell real estate at profits, or buy and sell real estate and offer some ancillary services that allows them to make up the loss that they otherwise would have on the sale price. That's in theory how it's supposed to work. Now, the problem with that is, if you take this to its logical conclusion, let's say Zillow is going to become the dominant player in the iBuying category, or let's say Opendoor, any of them. The reason why this is a terrible business, and I think Austin and I discussed Zillow a while ago.
Yes.
I had a problem with the iBuying business. I had a big problem with the iBuying business. I did not like the business because, let me go back to my statement. If I take it to its logical conclusion and they become the dominant player, then they become the marginal buyer, right? So basically what that means is they're going to be, in a way, competing with itself, or metaphorically, they are the snake eating its own tail. So they would end up propping themselves up. So if you take it to, again, its logical conclusion, they become the biggest thing ever in iBuying, any of these companies, they will become the marginal buyer and essentially cause problems for themselves. Now, there is another economic theory or statement, right, that says when you have a micro problem, it doesn't get better when you make it bigger. Okay, so what does that mean? So Zillow said there was a problem with their algorithm and how they were making these purchases. So let's say Austin goes out and buys a home. He buys a home for significantly over what it's worth, right? And we just lost Austin here, but I'll continue.
Yes, I am back.
Okay, he's back. So we take that, right? And Austin's going to be buying that house for less money. And he's a terrible real estate investor, right? It's not going to make things better if I give him $1 billion, right? So what I'm saying is the size does not make things better in these cases, right? Because each individual case, it's not about scalability. There's no scaling with houses. Each deal is its own deal, right? Okay, you might be saying wholesaling and stuff like that. No, we're ignoring that. We're just talking about iBuying. So basically you're going up to a family trying to sell their home and then you give them an offer. There's no scale in that category. Okay, you're not buying 100 homes for then slightly less. No, you're just buying these individual homes, making individual offers. So the problem is if you're really bad, right? If you make a mistake, right? Or there's an algorithmic mistake, right? And you're making mistakes, it makes things worse when things get bigger. Okay, when there's more money involved. So you just take like, okay, let's say you're buying with Zillow's case, they're doing this with $1 million, right? So the problem they're having with $1 million, right? Proportionally, let's say it's the same problem. Let's say they're overpaying by 20%, right? So that's a $200,000 premium. All right, let's take this to its conclusion of $1 billion. Now the $200,000 problem became a $200 million problem, right? The problem's worse. Okay, so if they're not doing things efficiently or perfectly at these lower levels, which is what the management's been saying, if they expand this to its logical conclusion to become the largest player, problems are going to get significantly worse. So while the management said the problem is good that we caught it today, going down the road, if we have problems like this, the problems are going to be exponentially worse. Okay. So Austin, am I making sense here? Because
yeah. And I kind of have a question too, because at least like when I was kind of looking through Zillow a little bit, I saw that they were actually, I don't even know if acquiring is the correct word here. They were like acquiring / creating multiple different websites and businesses, et cetera, within their core business. And I remember when me and you were talking, you actually told me that almost in and of itself kind of put you off a little bit, because that was indicating, at least in a subtle sense, a very subtle sense, that there might be a potential red flag in terms of how management is executing the business itself, because there might have been some internal issues within the business itself. Now, my question here is, are we seeing those internal, well, assuming that what I'm saying you would agree with right now, but let's for this question here, are we kind of seeing those potential internal issues manifesting itself now? And then if so, are you excited about Zillow? Because you were telling me that you might have been potentially excited about this investment. And now I'm really curious as to know why that is, Fabio.
So I'm excited because they're exiting the worst business possible, which is iBuying. iBuying's terrible. They have so many other strengths going for them in terms of their brand recognition. The fact that like you have consumer, I know I'm not alone. I literally will go into a neighborhood and be like, okay, what are the values of the homes here? Just, search, go on Zillow, it pins my current location. Boom. I have Zestimates all over me and I can see homes that are listed for sale. And I can do that same with rents. So these other acquisitions, I like some of them because they're buying like rental websites where individuals can find rentals, and then they're trying to expand the amount of services they offer within the real estate category, which is huge, right? So there's a lot of services that can be offered in real estate. They're getting into title insurance, stuff like that. And then they're trying to also get into the brokerage, but well, not trying, they are in the brokerage business now, but they're going to be expanding upon these and making them larger pieces of the pie. Just the iBuying business is terrible. It's high revenue, but very difficult to scale such a thing because every single market is going to be different. And the algorithm, or a lot of algorithms, how these companies design it, they're kind of like try to make it one size fits all. And then that's terrible. That's a recipe for disaster. And they figured that out. Unfortunately, some people really smack down on short sellers. And all this problem, this is actually what the short sellers cited as the problem. they cited the iBuying as a problem. So management has proven the short seller is correct. They themselves may continue to grow as a business. It doesn't mean that the business is a bad investment. However, it does prove that this avenue of business was a bad idea. And it unfortunately wasted shareholders' resources a little bit because they're going to have some negative losses. All of those homes, let's hope they liquidate them while the market's still good. They're going to get a decent amount of cash. We'll see that in the cash flow statement later down the road as they begin to liquidate these homes. And then I hope that they grab all this cash, and then, you know, whatever the losses were, cool, we can maybe write those down going forward. And then from there, I would say that I would like them to invest it more into the core business and grow the software side of the business, which I think is tremendous. So like if Zillow can focus on being the Google of home buying, fantastic. I think the opportunity is tremendous. I mean, anytime you tell me a website or has about 200 million monthly visitors, there's potential there. And then especially when you're dealing with the real estate category of home buying, there's so many different things that can be disrupted. I just don't understand why necessarily they went into the iBuying category. They thought they could make it something like you know what? They were watching, is HGTV on Discovery? Is that a Discovery program? They were watching HGTV and they were like watching those house flipping channels. And the CEO of Zillow was like, we could do that. You know, he loves that show probably. He's like, yeah, we could totally just do this. So that's my little rant, but
something I actually kind of want to think about now is just more so kind of, as I like to call this, getting into the head of the CEO here. What could have been potentially a reason why he would have considered this iBuying business in the first place? Next to that, which is my second question, is how could this, assuming that we're acting from the role of the CEO, Fabio, how could this have then played into their core strength should the iBuying business have proven actually positive, if it was like a positive investment that they had made there? And then I also kind of have another question too, just in regards to Zillow in and of itself, and whereby it's more so along their capital structure, which I know that we'll get into more and more and more. But I think, correct me if I'm wrong, they have 3 classes of capital stock right now, where ticker symbol Z is their C class of common stock. And I've been noticing, as I've been going through a couple of their SEC documents, I've been noticing not like weird things or like, you know, like fraud or anything, but like I've just been noticing that they're putting a lot of different things into this class C common stock. So those are my 3 questions to kind of get us along our way here, is if we were acting from like kind of the mind of the CEO, Fabio.
So what were the first 2 questions?
So the first question was, why would they have made this business in, like, why would they have gone into this business question. In the, yes.
What's the second question?
And then the second question was how could they have taken the iBuying business and have made that into, or not how, but more so like, what if the iBuying business had been a positive investment for them in this instance?
Oh, okay. I got an answer a little bit for them, but that's kind of like the consulting cap. So consultant cap going on. But I'll answer the last one first, actually, because the other 2 I want to spend a little more time. But basically, the classes of stock, let me see if they have, I think they have it at the top here. Yeah, they have a class. They only have 2 because these are the only ones that are publicly traded. So they're not going to tell you the third one. But class C and A, they throw class C around like it's, they throw it around. I'm not going to say anything aside from that, but they throw it around. The reason why it's because it's non-voting. So it makes entirely sense to throw away the non-voting one and reserve the voting ones, and don't dilute as many of those, because you're giving up control if you create more of those. So it makes sense to issue more Z shares. You're giving up economic interest, but not voting interest. Okay, so that's why they would do that. So that answers that question. Okay, so then why would they enter into the Zillow offers, which is going to be away? It's still here in their branch of businesses that's going away. Well, because it introduces more customers to the Zillow brands, right? So you start to associate yourself with, not associate yourself, but you start to affiliate with these brands and say, okay, you have Redfin. That's why Redfin got into it too, by the way. They all got into it. Actually, I watched an interview between someone at Redfin, and they were discussing why Redfin got into the offer game, and it was exactly that. Strategically, it's to get in front of the consumer's like mind, front and center, and say, hey, look at us. We offered you this house. We even maybe bought this house from you. Maybe you would consider using our other services. And that's the idea. Open Door, I don't even know. Open Door is just literally, just trying to buy houses. That, as far as I understand, I would have to do a lot of research on Open Door. You can say in the comments if I'm wrong, but I think that's what Open Door just does. And then there's the other one that I'm forgetting again, but you can comment down below if they're doing other things. So you can see here that kind of like the point of Zillow was to offer these ancillary services. And where they could have probably gone better is if Zillow was able to, over time, and this is kind of like, no one wants to do this because it's a slow and steady route, it's boring, but it's very powerful long term. If Zillow were able to transform themselves into like a quasi C Corp REIT, right? What I mean by that is, think of Blackstone and what they do with real estate. They buy up these real estate slowly over time, more conservative. They're actually better at it. And they build this portfolio of real estate, of residential real estate, and they just rent it out. Cash flows. Now, some people might be cringing at that. Some finance guys might be cringing at that because like, oh, it's not the most efficient use of cash flows. The returns are going to be that great. Yeah, sure. Yeah, well, that's true. But if you put more of like the human touch, as for now, because the problem with the algorithmic approach is you're basically automating a process that right now it's too dynamic. So either they have to make the software a lot more complicated and capable of interpreting the dynamic nature of markets, which is currently very difficult, right? No one's been able to do it clearly. No one right now has been able to do it. And able to basically decide whether or not something is a good deal or not, and truly intimately know each market that they're operating in, or they add a little human touch to it, and with the right incentives, slowly over time, build a portfolio of properties. That's one way they could do it. And some interesting things about the C Corp approach, which is actually what Blackstone changed to, you can see they changed from a partnership to a C Corp, is they would be able to, unlike a REIT, they'd be able to restrain most of their earnings and reinvest back into the business. But a REIT can't do that. REIT must borrow typically to expand, or the difference between the GAAP net income and the actual funds from operation will be the delta between that they can use to invest in properties. So that's my answer to 1 and 2. Why they did it and where they could have maybe done better is they could have just done that, but they're probably not going to do that. And that's a slow and steady way. Unfortunately, they don't want the slow and steady. But that doesn't mean they're not going to be successful in the other parts, which is, I think I like Zillow Rentals. If they can be the intermediary between me and my rental property. So for example, if I can put my, if I own a portfolio of properties, if I could just put it on Zillow to rent out, and then Zillow access that agent, that'd be amazing. By the way, in Florida, for example, it's not attractive to be the real estate agent helping the customer for rentals. You're not going to get much for it. But the point of it is to, kind of network and get your name out there. But like, for example, Zillow, a lot of agents don't want to do that. And so Zillow can actually penetrate that market really well. And they have, for example, HotPads, StreetEasy. They have a lot of platforms now that basically offer a way for people to look for rental properties. Not for rental properties for me to buy, but for me to rent, right? So they have Zillow closing services. So all these ancillary services come into like one package where you can upsell each part of the transaction. And there's so much opportunity here. That's the key word, opportunity. They could absolutely fail in everything. So that's your main risk. They are pretty much very successful, or were hyper successful, and kind of still are, in the Zillow Premier Agent, which is basically how they have, when you go on Zillow, you look at a house, there's going to be like that agent that's kind of recommended there. And then they say, okay, hey, you want to use this agent to go look at this house, and that agent is paying to be there, right? And they bid up that process. So, because again, Zillow has 200 million visitors. So It's a place for leads, actually. It's like, it's a lead generator. It's a very good lead generator. But if they can successfully get home loans up and running, you know, and where it becomes a significant part of the business, that could be good. Zillow rentals, closing services. And if they could actually shift over into the broker side of things and kind of facilitate those agents and get like a tiny cut from it, that would be very powerful. And I think they are doing that. I'm pretty sure they are doing that. So that kind of covers the business. Why they went down, again, to reiterate, they went down because they're exiting the offers business. So a lot of people think that's negative. I think that's fantastic. I'm going against the grain. That's amazing. They're getting out of that. Terrible business. And they already had the traffic to begin with. So terrible business. They didn't need to get in there. Let Open Door take care of that. You know, if they figure that out, good for investors in Open Door, but I don't want any part of that. And I would, rather than focus on these platforms, build out these platforms and, you know, acquire a brand portfolio of platforms, you know, so you don't have only Zillow tied to your name. They have Hotpad, Street Easy. You would go on these websites and you wouldn't know it's Zillow. You're interacting with Zillow. So I think from there, we can kind of delve into the discounted cash flow model.
Yeah, I was actually going to say that we should take a look at that. And then also another interesting part too about Zillow as well. And you kind of brought this up earlier. It's how many different businesses currently Zillow is getting involved into. And as well, kind of just, you know, just like a little tiny question here. Where do you think would be most advantageous for Zillow to potentially go to next? Like, where do you think there could be a potential opportunity for Zillow to go to leverage its current existing like business itself, to leverage its business into these new avenues? What do you potentially think an interesting new market might be for Zillow, if you can even comment on that, Fabio?
Okay, so mind you, like non-expert opinion here, but
yeah,
as
this
an
is
investor,
just two guys at capital mindset.
yeah, because
You know?
there'd probably be some, I don't know if there's some legal loophole, not loopholes, but hurdles to cross this, but it would be very interesting if Zillow would focus in on becoming the broker in real estate. Okay, what that means, you know, they become the broker platform, and then under them they have all these agents that do kind of the agent work, and you know, they get the commission still, or they can structure it however they want. But that'd be something for the guys who get the big money to figure out. But I think that part would be very, very lucrative. Or transitioning over from that model into eventually some sort of like, I need to buy a home. I need to go look up to see if I can buy a home, and they can make the process very easy for me. Then that would be very interesting for me. I think actually in the future, the real estate market may go in that direction to some degree. And I think Zillow's primed for that. Okay, so if they can succeed in that, because I bet you Redfin sees this too. Redfin, for example, they pay their agent's salary. They do all these different things for incentives to kind of change the dynamic of how the agent interacts with the customer. And I think Redfin also is moving that direction. So keep an eye on Redfin as well. But Zillow gets the higher traffic. It's they don't have this network the same as Redfin. They don't have all these agents that are under salary. It's just like Redfin. They're a little bit different. But if they could focus on maybe not having the salary part, because that's some costs, right? They just do the commission base like a broker. Oh, that's fantastic. You can build an army of agents, like an absolute army of agents, and you act as their broker, and you get like a small cut commission from each transaction that they do. Again, I don't know if there's any hurdles aside from that, but I'm pretty sure that there's nothing really stopping them from doing that in every single state. It would severely destroy or maybe perhaps harm or cannibalize their premier agent business, which is the advertising, because you don't want to pick favorites on your agents. You kind of want to let your agents operate and try to get customers and then use the Zillow platform themselves. But aside from the point, and then if they focus on that, I think that's going to be very high margin, gets their reaches everywhere, and then they can focus on building out the eventual transition to kind of like a seamless transaction for me and you. Like, let's say you want to sell your house, you just put it on Zillow, and then Zillow itself, the platform. Exactly. Yeah, you're thinking it. And then the buyer can get the loan off of Zillow. You know, they don't have to give the loan out. Remember, they can just be the mortgage originator. Okay. They do not have to be the lender. They can facilitate the loan, right? So everyone who's thinking, oh, no, they shouldn't get into that business. No, don't worry. No, they're going to be the MLO, right? the mortgage loan originator. They're going to facilitate the loan. The bank will give you the loan, or whoever gives you the loan. And that's how they can operate that. And then on top of it, they can do the insurance, or they can facilitate the insurance. They don't even have to give the insurance. A lot of people think that, they're going to be giving out the insurance. They don't have to do that. They can. It'll be higher margin for them if they just facilitate the insurance and they act as the, so like basically you want mortgage insurance, you need mortgage insurance or a title insurance. So they can facilitate the transaction between you and a title insurer. Or, if they want to go really aggressive, they can be the title insurer. If they think the algorithm, right, that they can automate that, which may be easier, a lot easier than automating home buying, a lot easier. Okay. Automating risk calculations is a lot easier than automating price discrepancies and what is the fair value of a real estate in this market, because there's too many variables, it's too dynamic. So that's kind of like where I would be very excited for Zillow, which makes me excited for Zillow because I see them, they're kind of like positioned right there. So if they execute on all these things, this could be a fantastic investment, especially at current prices. It's about $16 billion market cap right now. Seeking Alpha has it wrong. So if you look on Seeking Alpha, that's wrong. And that has to do with their classes of stock.
So if I can cut in here just for a quick second, during our DD, I think me and you, Fabio, should actually kind of really explore deeper exactly just sort of the potential behind each one of these businesses that they're getting involved in. Then even outside of Zillow itself, we should also orient our DD to the general market as a whole and kind of see the way that Zillow is positioning itself in this market relative also to its competitors too. Because I hear a common criticism, Fabio, that Zillow has no proprietary technology. Zillow has no moat, by which you would obviously disagree with the moat because the brand equity and and the fact there's 200 million people visiting the website is a moat in and of itself. However, I keep reading all of these people that are very, very negative towards Zillow. And then I also see a lot of the shorts and their thesis too, which actually I can understand the shorts thesis. And that's something that we need to orient our thoughts towards when we decide to do a DD into Zillow itself. So that's just my thoughts. And now kind of moving on from here, Fabio, I think we should move into the discounted cash flow model now.
All right, let me actually correct something I stated. So I'll state the monthly users. I probably was mixing up another company, but it's about 36 million. So before we continue, 36 million, but 36 million for homes is significant. I know it's just next to the number I was using. It's not small. No, that's huge. It's the most popular in the world. And you got to understand that, it's different from Facebook. So I'm actually probably was, no, Facebook is, I think, a billion, like across.
Yeah, Facebook's platform. A lot of people, but like Facebook is a lot more.
I was probably looking at another company, and then just my brain was remembering the wrong number. But yeah. So it's about in the 30s, 36 million approximate monthly unique users. Oh, you know what it was? No, it's probably I read that they got 200 million visits, so it's not unique. Okay, so basically, like, I can go on Zillow multiple times. So if all those 36 million, some of them go on like 10 times, right? So those will all count as a different visit. And then the unique is like, I do it, you do it, our audience each individually does it. That's okay. So that's the separation. So I was just to be very clear. So in case there's any confusion, you might say in the comment section, I'm addressing it here. It's 36 million unique users around there. And at least I think that's the October number. And those individuals can visit multiple times. And that's where the 200 million figure came from. So yeah, 36 million unique users is ridiculous for real estate. All right, so going to the model, let's actually pull that up now. We know that the cash flows are negative, so we actually had to adjust for that. And basically, when we adjusted for that in the model, we also adjusted for the fact that the Class A shares, which is ones we're talking about, we're not talking about Class C. The reason why is I wouldn't consider Class C. I don't want Class C. I don't care for it. I want voting power. Some people might say, well, your vote's not going to really matter anyway, because you own so small amount of the company. Yeah, but I want to own the shares that has the power, because for those who like, if I'm trying to sell it in the future for whatever amount, they're always going to go for logical premium, right? It's logical for them to be premium. There might be a moment in time where the premium doesn't exist because maybe the buybacks are more concentrated on one class more than another. But that's a different story. And that case study, I'll point to Google. You can look at Google for that. But that's not a video about Google, so we're not talking about that. So going into the growth rate assumptions, we can see that basically if I assume no dilution, no buybacks at 20% required rate of return, I'm not looking too good. I would have to assume 40% or above. Well, I think I can assume, let's see if I plug in a 39. Yeah, 39 works. Let's do 38.
38. Yeah.
Yeah, so 38. Cool. So I can assume a 38%. Now, if I lower my return expectations, 15%, which is significant, some people again will say 20% is way too high. Lower that a bit. There you go. You can witness a 15. And for those of you who are looking for a 12, I'll put that out there. So, and then we can lower these growth rates for those who are wanting us to be a little more conservative.
5%.
Well, 5% is a little, let's be realistic with Zillow. So Zillow is still in its growth stages. It's attacking a unique newborn market in a legacy industry of real estate. So I think 20% is good. I think let's go 25. Let's go 30. Okay, so we want to extend past that too much. Let's do 22 and let's do 23 to give our audience an idea. So I'll count 23. So if someone's looking for, above market rate of return, and when I say above market, it's above the historical average of the market, historical average. So I have my gripes with that, but that's not a video about that.
Yeah,
a lot of gripes that I'm not addressing.
A
lot of gripes.
Yeah.
But to be specific, if we're just going off statistics, that's what it is. 12% above average market. That's what you can expect. Let's say you want to assume some dilution for those of you who are looking down and you have your eyes are wandering over down here to the average buybacks of the past year. They've been diluting you. So let's assume dilution. So let's assume negative 5%. All right, negative 5% changes everything, makes it really bad. Now you got to assume higher growth rates for the same 12%, and forget it if you get to a 20% rate of return. Forget it. You're gonna have to wait. You have to wait for a really nice buying opportunity, or assume really high growth rates. So if you assume, let's see, 40. Nope. But we're not that far. 50. All right, 50, between 40 and 50, somewhere around there is where you'd have to assume. So probably close to 40, 45, we get closer. See, 45 and above. Between 45 and 50% is where you want to assume given those scenarios, which Zillow could do, by the way. Zillow could very well do that. We are normalizing the cash flows, right? They're going to have a big amount of cash flows coming in because it's going to be a reduction in inventory. We're going to see that. They're going to take a loss on a lot of that. I think they disclosed that they're going to take a loss or potential loss. They're going to take a potential loss on a lot of that inventory, but that cash flow is going to show up and it's going to see a huge growth. So don't fall for that mistake or mirage, right? You want to normalize those cash flows when they come in. Okay. So for those of you who are, making your own judgments and your own valuations at home, when you see that come into the cash flow statement, it should be coming around over the course of the year or so. You're going to see really high cash flows. And let me see. I think I might have it pulled over. I think it's in here. The slideshow. Actually, I'll show them to the model. It's a little nicer. All right, so I will let me zoom out so everyone can see. All right, and let's describe, because I know some people sometimes may not be able to read even when it's zoomed out like this. So let's describe what we're kind of seeing. So if you see cash from operations, it's about negative 425, and that's for the total company. So if we take the previous year's cash flows, I want to highlight just this number right here, which is the change in inventories. And so we see a negative billion. that reflects the additional homes they added to their portfolio. So you will see them dumping this over time. And from that, you're going to see a higher cash from operations because inventory, it's going to be positive instead of negative. Okay, as they're exiting this business. So it's going to show like a mirage of high cash flows. Then you will start to say, okay, from that, you want to look more at the net income. You know how normally I hate net income.
Yeah.
Not hate it,
Yeah.
but I talk about the problems. But here's where gap actually comes in, and it's showing you the truth. The cash flows will normalize. Okay, they'll come back to net income, but it will be the opposite. It will be a fake upside surprise. It's because normally companies aren't flipping inventory. So for the majority of businesses, they're not flipping inventory, right? These homes are flipped inventory. Because they're flipped inventory, gap is actually very useful because it will reflect the loss you're taking on it. The cash flows, well, you know what? Someone's saying there, the cash flows will kind of reflect it because the net income will reflect it. And remember that the cash flow. So yeah, but you'll see it better in the net income. You'll see it separated. So just be aware that the cash flow from operations will be abnormally higher relative to in the past because of that dumping of inventory. So
Can we take a look at the key ratios for just a quick second there?
Yeah. Let's
just
take
kind
a look
of
at those. So
a
I'll
little
zoom
bit
back
curious
in
with something.
because we're not looking at the account statement. So I hope for everyone that they can see. It's okay. Let me move this. All right. So
That's a very interesting gross profit margin right there, Fabio.
yeah,
You see that huge discrepancy going on there?
Well, it makes sense.
But it also does, because where my mind goes with this is that between 18 and 19, that could have been potentially when they started opening the new avenues of their business and then started to incur those costs of revenue, which was then impacting their gross profit margins.
Yeah.
The point being here, yeah.
No, I actually have, that's why I had this open actually, because I wanted to show this. So the Zillow, oh, gosh darn it. I want to do that.
That happens sometimes.
Bear with me, everyone. I got to get back to where I am. Okay, it's towards the end. Is it here? Yeah, here we are. All right, so Zillow offers revenue. Zillow offers cost of revenue, gross profit negative. Oh, that destroys your gross margins, right? So you have the software side of the business, and we can probably they probably have it before the internet side of the business. They better have it. It's probably in here somewhere. Okay, yeah, right here, gross profit. So they have the gross profits total. So you can see here the home segment, IMT segment, mortgage segment, corporate. Okay, yeah, they have everything kind of separated. Well, income, this is income loss, and this is the growth rate. So they just have the total gross profit. I thought they would have the gross profits of each one. They probably do somewhere and you can calculate it, but the point is the software side of the business is going to have a very high gross margin, and the offer side of the business is going to be pretty terrible. So yeah, that makes sense why this happened. This is where they got into the iBuying. They just destroy their margins. These margins will get better as they get out. So get ready for that. And that actually might boost the stock price for all we know. Because sometimes Wall Street likes to see, I mean, obviously everyone likes to see improving margins, but the facade might the
markets might react favorably to improving margins.
Exactly. May or may not. So
may
net
or may
profit
not.
Margin,
yeah. This isn't a statement of like definitive fact. It's just a hypothesis we have. So
net profit margin, they're not making much money now. So it's really low. ROE really low. Let's get rid of this. So none of this really matters right now.
Yeah.
At this stage, this matters now because of those homes, those silly homes they got into. So we can kind of see what's been going on. Yeah, look, the home buying business, because we're looking at their inventory on their balance sheet. So it's been getting better because things got kind of crazy in terms of iBuying and selling homes, right? Buying and selling homes got pretty wacky. I would expect them to normalize.
Yeah.
Yeah, like this is probably reflecting, you know, the change.
I'd probably
Any
say so.
questions
That
here?
nice.
It's the reason why we're looking at inventory for Zillow, a software company, is because they got into the iBuying business. Otherwise, I wouldn't even care about this.
Yeah. Well, I mean, like, honestly, like these are all like pretty much self-explanatory to everything else we've been speaking about in the video itself. So Fabio, do you have any other thoughts regarding Zillow, or when we do our DD of Zillow and the market that it's in and the industry that it's in, et cetera, and so forth, and the businesses it owns and then might potentially acquire in the future? Is there really anything that your mind is immediately primed towards wanting to investigate further during our deep dive analysis of this company, Fabio?
Well, here's like kind of my preliminary thoughts. I'm actually thinking if my ASPS position is already up significantly. If I were to sell today, considering it's like still my kind of, it was a spec position and it's now grown nicely beyond what, you know, the cap I had on it, because I'm just letting the winner run at this point. I would actually take the proceeds from that position and probably dump it into Zillow. And, you know, kind of keep Zillow as a more aggressive spec position, but, you know, I might do it over time. And then if ASPS reaches for those who don't know, we did a video on ASPS, a different stock, but if my profits from ASPS come to it's like kind of like the full realization that I kind of have some expectations for, I'm definitely going to be easing those profits in, and I'll be buying Zillow and adding Zillow from that. And it's kind of like poetic because, you know, the business that ASPS is in,
Yeah,
the
right.
business that Zillow is in. It's kind of poetic.
Well, I mean, the other funny part about that too is that speaking of winners, my ACI investment, Fabio, is up like pretty sizably. So I'm probably not going to trim that position down. I'm just going to let the winners run as you put it. But when it comes to ASPS, I might do the same. I don't entirely know yet. There's a couple of questions that I'm going to actually save to the DD when we do the DD that I need to have answered, or at least have an ability to make an educated assumption about what the answer could be regarding some of the issues I've been kind of noticing with Zillow. But we'll save that for the DD, just for the sake of this nice little preliminary analysis video, you know?
Yep. So to conclude, I'm very interested in this business. I very likely might conclude that it's going to be added to my portfolio.
All right. Well, folks, you have heard it here first. We're your hosts, Austin and Fabio. If you've liked what you've seen here today, please be sure to share our video. It really helps out our channel. Please also be sure to visit our website at capitalmindset.org. If you scroll all the way down to the contact us form, you can ask us to do preliminary or even deep dive analysis on specific stocks that you're potentially interested in. As always, we are not registered or licensed financial advisors, so nothing here is financial advice, and we're not giving financial advice. This is just for entertainment purposes. But if you've liked this episode today, please be sure to like, comment, and subscribe. We're your hosts, and that's all, folks.